Tuesday, June 30th, 0648 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. The last trading day of this month, finishing the second quarter of the year, halfway through the year. That's a lot of things that already occurred. So I'm going to go over the Dow Jones Industrial Average Stock Index, one of the oldest stock indexes, and a big event that occurred yesterday. I closed the trade. I closed it for a winner. I made 30%. That's all. Thank you for showing up. Bye-bye. Just kidding. There's a lot more to it than that. The Dow Jones Industrial Average Stock Index. 30 companies. I posted a video. I shared my wisdom, insight, history a few days ago. You can check that video. It goes over all the companies in that stock index and the leading up to an event that occurred yesterday. That event was one of the companies in that stock index was changed out. I knew that days ahead of time. I prepared myself for a trade. I made that trade, closed it for 30% profit. Using the stock index, not the individual stocks. So basically what happened was they removed Verizon off that stock index and replaced it with Google. Totally two different sectors and industries. Again, that's all detailed in my other video. Because I knew that was getting ready to occur the day and time, which was pre-market yesterday, I was looking for a trade idea, and I selected the Dow Jones Industrial Average. The stock symbol for the underlining is DIA. That's the one I used. I did not want to use Verizon. I did not want to use Google. One of the reasons why this was an option trade, and options, most company stock options are terrible for trading. Put that in parentheses. Most company stock options are terrible for trading. Most people that trade those go out and buy call options. Yep, out of the money, majority of those fill. I did an advanced strategy. I did credit spreads instead of debit spreads. I'll show you that momentarily. And also I selected the stock that had better spreads, better liquidity. I know there's a lot of information, and I'll share a lot of that here. So we're looking here at 4 charts. The futures market, yep, another stock exchange that's available to trade right now. Each of these is a 1-hour bar. Again, this is the futures market. I get the stock indexes, the far left, the ES, the second from the left, NQ, the third from the left here, YM, and the last one on the far right is RTY. Stock indexes. Just to give you some comparison here. The far left, the S&P 500 futures. Again, ES is the symbol in the futures market for the S&P 500 futures. Last night, because it's trading right now, made a higher high than the close of yesterday. All right, the second one here, NASDAQ 100. Again, the symbol's NQ for the futures. Made a new high from overnight. Now this one, YM, is a Dow Jones Industrial Average Futures. It has not taken out the high of yesterday. That's concerning. And then the far right, the RUT, the Russell 2000, has not taken out the high of yesterday. So obviously we know these first two are the stronger index. Now I want to show you again the trade I took on the Dow Jones Industrial Average. I'll show you the cash index first, and then we'll look at the futures. And the difference is, excuse me, we're looking at the futures now. That's one stock index. Again, the futures have different hours they trade, longer hours than this stock market. So when someone says the cash index, they're talking about the regular trading hours, underlining regular trading hours, 09:30 to 4 p.m. So now we're looking at the Dow Jones Industrial Average cash, which simply means the regular trading hours, not the futures. Obviously, it's closed right now. It's not trading. The Dow Jones Industrial Average Stock Index here. The far right, the monthly. Yep, all-time new high. It's bullish. Look at here, the middle chart, the weekly. We haven't taken out the higher low of last week yet, which happened to be last week, the all-time high. Retracing the big wick on the top. In the daily chart from yesterday, again, the cash index not open yet till 9:30. The cash index here, higher high, higher low from yesterday. This red candle is a bearish pin bar, which happened to make the high of the year. And we're retracing that. I'm not expecting necessarily 100% retracement right off the bat on here. No, we might get a pause somewhere or a pullback. So that'd be short term. And here on the weekly, same thing. Testing the big wick on the top. They are bullish. They're all trending up. That's good. Give me more confidence to take in that bullish trade. I did not buy the stock. If you buy the stock, it's directional. You only have a 50-50 chance to be right. Again, you buy the stock price neither goes up or goes down. You only have a 50% chance of success. Trading options, if you do the basic method, buying a put or buying a call, again, you have to be directionally right. It has to move. It has to move fast because time decay works against you. So you would need the underlining. The underlining would be the stock. You would need the stock to move up fast. The strategy I did is a credit spread. The stock could sit sideways. Stock could go down. Stock could go up. And I could still win, which I did. So I mentioned to you, the stock index had a big event occur. So I'm going to show you here. On the left will be the underlying stock, which I'll cue in a minute, but I'm cueing these to the daily charts first. So this was a real short-term event. On the left is Verizon. Going to put it on a daily chart. Let's simply put it for year to date. Year to date. Each chart. Again, each chart is a daily chart. The left is Verizon. The right is the Dow Jones Industrial Average Cash Index. Yep. Look at the left. It was the close of yesterday. I told you they removed Verizon. My expectation was Verizon was going to decline. What happened? It went down huge. Yep. They're removing it from the stock index. This stock index doesn't mean they're being removing it from every stock index, but the Dow Jones is the biggest and the oldest stock index. Sorry. The Dow Jones is one of the oldest stock indexes. One of the most prestigious stock indexes, has 30 companies. Removing this Verizon off the index means a lot of companies that also mirror the index, they are selling it because they want to be in par. And again, if the index doesn't own it here, they're removing it. More sellers than buyers. What do you think was going to happen? As expected. Yeah, there could be news or earnings overlapping that, but they made sure it wasn't overlapping necessarily. One could have traded bearish. That was my other pre-market trade ideas I was sharing with you all. This was shared to my Patreon members on the higher level, as well as kept them informed on my WhatsApp group. Huge sell-off. Where the Dow index, higher high, higher low on the daily chart. Big difference, right? Yep. Now let's put Google here on the left. There's two Googles. This is the one that was added. Yep, the company has two Google stocks. Who owns Google? Alphabet. You can check that on my other videos to explain why. This was the one that was added. Look what happened yesterday. Higher high, higher low, as expected. I did not take this stock neither. Again, I chose the Dow to trade. So now I'm going to cue in the Dow stock index, ETF. Again, what we were looking at here before, the cash index. You cannot trade the cash index. So use the stock ETF. Stock ETF DIA. Yep. Same thing. Cash, regular trading hours. And look, it went up. So now I just shared with you the bullish, the bearish, how they played out. Again, Dow Jones Industrial Average, we moved Verizon. They replaced it with Google. We saw Google went up. Verizon went down. The stock index went up. Stock index is 30 companies. That video I shared prior days ago goes over every single company in the Dow. Now we'll go to the option chain. The option chain on the DIA. And the option, again, I chose, the strategy I chose gives me a 70% probability. I did not go out and buy directional. I did not buy calls, puts directional. And because this event, I knew what day it was occurring. The trade I placed was last Friday, near the end of the day. Near the end of the day, I placed the bullish trade last Friday, and the contract I chose was the 10 July. So when I placed the trade, it had 14 days left. I chose the short-term one because I knew the event was coming in soon. As well as this Friday in the United States, the stock markets close because this Saturday is a federal holiday called Independence Day. I did not want to be in this position long-term because I knew this was a short-term event that was occurring. And like I said, coming to a holiday. So I chose again the 14-day one because there was nothing that had 7 days to my liking. And derivatives, options, futures, they're contracts, they're derivatives, they're the expiration dates. So the market's closed right now. Pre-market's moving. And the bid and ask, I chose the stock ETF DIA, or it's actually the SPDR, but some companies rebrand it as ETF. I made sure the bid and ask was tight right here when I traded it. So again, it's pre-market right now. The prices are terrible. But pre-market, it had a tight spread. First, Google and Verizon, their bid and ask, not necessarily was good enough. So again, I choose the underlying stocks that have a tight spread. Choose ones that have a high volume. Again, this is market closed, but again, it's pre-market right now. So there's a little pre-market activity. So you got it. I chose this stock ETF because it had better spreads, better volume on average, and even that day than the other two. Good money management. And I chose a short-term contract, like I said, because of the time of event. Bull put spreads. This is how I did it. I had selected the strike 514 on the puts, a bull put spread. Again, bull means I'm looking for prices to go high or remain high. Bear call would be on this side. I did a bull put spread. Nail that in, hammer that in. Bull put spread. I was bullish. That's why I bought puts. Sorry, I sold puts. Bull put spread, sold puts. So I sold the 514. I'm going to cue it in. Sold the 514. Bought the 509. That's 5 strikes wide. That's a margin trade. That's $500 you have to have minimum for each spread, then multiple spreads. So just one alone, one alone was 5 strikes wide. It's $500 margin. Yeah, I'm taking $500 from cash into a margin account. And because it's credit, I'm receiving money. So when I put this trade on last Friday, pay attention here. Again, I told you the 514 strike is the one I shorted, and I bought the 509. So 514, when I did the trade, this column on the far right, delta, this delta right here, which is now 24, but it's irrelevant. Now it is. At the time I did the trade, it was a different delta. Yep. So that delta at the time was 37, much higher. For me, that was higher risk too, because I took a higher delta. If I went lower, one standard deviation or two, I'd rather have that. But I selected the higher delta because it had a minimum amount of dollar amount I want to collect. Yep. Again, these prices are not valid anymore because the market's closed, but they were tighter. So when I put this on last Friday, those were the strikes. And the credit I received last Friday was $123. So you see it's less now. Yeah, when you do credit spreads, when you're in a position, you want to see the credit amount decline. And then you're making gains. Credit spreads, like the insurance company, when it sells your insurance policy, you're paying a premium for it. And if you doing, let's say, insurance policy for auto insurance for 1 year, they might have you pay 12 months up front. And then again, during that 12-month period, if you decide not to stay with that policy and you want to close it 6 months down the road, well, you're going to get the difference back, but you're not going to 100% back. And the company that sold it to you pocketed the 6 months. Same thing here. When I put this trade on Friday, I collected $123. And because the stock did go higher, which I'll show you momentarily, and there was time decay, meaning again, Friday, and then you had the Monday, part of the price melted away. Yep. So I closed for a profit. Nice. So this is, again, the Dow Jones stock ETF. I trade it. I want to put it on 30 minutes to show you. Put it for 5 days. Right here. Actually, let's zoom in. This was Friday. I put the trade on around here. And I closed it yesterday morning. So the stock went higher. In the morning, when I closed the trade, the stock went higher than the high of Friday. So that worked in my favor. The stock went higher. Let me cue in the trade information I did too. There we go. Yep. That green candle there, lower high, lower low. Yep, the trend was down last Friday. I took a bullish trade, contrarian. Bull put spread. I did it again, the contract July 10, had 14 days till expiration. The delta was 39. Actually, it was 37. So 39, 37. I recall it was 37. Again, yesterday went up higher high, higher low. Let's go back to the option chain to finish this, explain this. The contract still has 10 days to expiration. Yep, you could trade it and close it before it expires. So I left money on the table. I think some of you already realized that. Yep, the max I collected, I said Friday was $123. That was the max I could make on that position. I closed it early. I did not make the max. To make the max, I would have to stay in it until July 10th. Well, a lot of things could go against me, go up and down, sideways. The point is, I told you why I closed it early. There's a short-term binary event. But I closed it yesterday at $86 per spread. So again, $500 margin for each pair. Collected 123. Sold it yesterday morning for 86. That gave me a 30% profit. 30% profit. That's beautiful. Without even sitting in a position till expiration. Yep. Opened it Friday, closed it yesterday, 30% profit. That's a beautiful thing. I'm a happy camper. It worked out the way I wanted it. Sure, if I stayed in it longer, there's a possibility I could have made more money. There's a possibility I could have lost the trade. Yep. Good money management. So you see here, that's a strike. Again, Friday, here is the candle high and low. So I put the strategy on, bull put spread, and I used strikes that were below the underlining. So I'll put it on the 30-minute now. Extend it out. Let's put it for 10 days. So yellow horizontal line was my short strike. The risk was if the stock goes down, the underlining stock, DIA goes down and touches my short strike, 514, that's not good. If it goes lower, that's not good. So I chose this short strike further away than the other lining, reducing my risk. I'm collecting less money because I'm further away. And if I went lower, 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 I'd be further away. So I clicked this, I used the sweet spot, which I tell you the delta was. Yep. Nice. Now, we'll finish this off. I want to show you. Put this on 30-minute. The left is the YM, the futures. Again, the futures has extended trading hours. The left, the YM, the futures, I could trade options on that too. The pricing is terrible in the futures market for options. I've done them sometimes, still do them sometimes. The option and the fees are terrible. The liquidity is better on the stock index and the fees are lower on this stock. And I told you, most stocks have terrible option pricing. That's some good insight I show you. But again, most people choose stocks with terrible option prices to trade. Disadvantage. And then there's timing. Yep, using charting. Again, it's one reason why I chose this stock at that time. Thank you as always. Spending just a little time with me. That's it for the video. Thank you for watching. Thank you kindly for your support.